Hey, retirees and future retirees. My name is Justin Hodges. I'm a financial planner and I own my own independent firm called the Wealth Tenders. And here is a quick example of a distribution strategy for retirees that includes the three buckets essentially. Now, what those three buckets are, and I'm going to keep this very, very simple, of course, for you without too much portfolio jargon or lingo, is we're going to have short, mid, and long term. Because when you retire, let's say you retire at 65, for example, and we'll just use that as a starting point, obviously you're actually still young when it comes to your money needing to work for you for the rest of your life, right? You could very well live to be in your 80s or 90s. So 2 to 3 decades, you have to make sure your portfolio can last through that. Not only so that you can pluck the distributions off yourself to enjoy and travel with and spend and gift or whatever, because you worked hard for it. You should enjoy some of it. We're all in agreement here. But also, you may want to leave some for your estate or whatnot too, as well. So it's still a ways out there, even though you're 65. 65 to 95 is 30 years. And you look back, you're like, wow, that's a lot can happen in that time frame still. So you are still young when you retire when it comes to how your money should be managed. So you can do yourself damage if you sit either too conservatively or possibly too aggressively based on your tolerances and some other factors too. Other factors could be, what is your fixed income already? If your fixed income already is like a healthy social security and maybe a pension from an employer, or you have some solid real estate income or royalties from a business you sold essentially too, you could probably play a little more aggressive with your stuff long term and just because you're not needing to use it necessarily if you have fixed income from those other sources. Um, so everyone's a little bit different here is what I'm getting at. But essentially, when I construct a portfolio for some of my retired clients, when they're hitting that point, we're going to have the short term. This is kind of the getting used to it phase too. So this is money inside. Let's just take an IRA, for example. We're going to have that thing layered. So maybe you only have one IRA at the time for me too, just to keep it simple. Inside that IRA, we're going to have a whole mix of components. There's going to be cash, money market, stocks, bonds, ETFs, essentially mutual funds. So how I manage money is I really like to use ETFs, like low cost ETFs, money market, and I will dabble a little bit in treasuries or bonds, essentially, whatever you want to call them. Um, what I really want, though, what I really believe in, and the portfolios I like to construct too, is I like high dividend ETFs. Obviously, I like broad market ETFs. Now, those are going to be a mix of your mid and long term buckets there. Let's kick off with just your short, though, to start. So, your short term bucket is going to be 0 to 5 years. This is usually money market, essentially. I want you to keep 2 or 3 years. I'm going to take what you need, right? If you need 50 grand a year to survive in retirement to cover your liabilities, essentially, just to live and worst case scenario, this is what we have. I'm going to keep 2 or 3 years of that at least in cash or money market in your account at all times in your IRA. So that may be 100 to 150 grand roughly. And again, everyone's a little bit different here too as well. I may peel that back a little bit based on your spending habits, based on our relationship working together, just seeing how you budget and live essentially. Because again, we don't want to sit too heavily in cash. For example, right now, yes, we can make a risk-free 5% rate of return roughly on money market. That's not going to last forever. That's been a product of the last year and a half or so. Typically, that's cut in half, 2 to 3, I'd say, in the normal environment that's stretched out. So obviously, when you factor in inflation and just the cost of living, you cannot sit too heavily in cash, and you cannot have all your assets in cash forever because you're still young when you're 65 when it comes to managing your portfolio over time. So in the first 5 years, again, we're going to have some dividend-focused stuff. Those dividends are paying out, obviously, quarterly into your account. If you're taking distributions, wonderful. The interest from the money market or cash is obviously paying out monthly inside your account. These are all the mechanics happening inside your account typically. But pretty much in those first 5 years, we want to have enough cash to cover 2 or 3 years of your lifestyle if something were to happen and everything just disappeared essentially. So usually the world ends, but nothing too speculative. We don't want it bouncing around too much. We want to make sure we have that. It creates peace of mind for you. The next bucket is that midterm bucket. That's somewhere in that 5 to 15 year mark. So we may have, again, plugged in there, we'll have some broad sector ETFs, a lot more dividend focused though ETFs there too. We want to generate some income inside of there too, but still have some growth over time. And then that long term bucket, we're going to have anything above 15 years plus out there. So, for example, we might have some more growth focused ETFs inside, that bucket too, where we are trying to pick up growth over time. These may be technology companies, for example. Anything that we expect to grow long term. They're not so much income producing now, so this is not really your dividend focus. This is not cash. This is not money market. This is not bonds either. These are long dated equity ETFs where we can pick up that growth over time as well. So you have those 1, 2, 3 buckets. We're pulling from bucket one, the short term, in those first 5 years at all times. Because remember, interest on cash is paying out pretty much every month. Dividends are paying out every quarter, essentially. And so you have this nice distribution strategy packed into just your one IRA. And it's simple for you as a client. You'll see your, I use Fidelity or Schwab for all my clients' accounts. They'll just have one Fidelity IRA. We'll set up a monthly EFT distribution into their bank account. We're probably aiming for, 4% or so is what I usually recommend for my clients. And they don't really care to know the rest of it typically inside of there. But what I have done, again, is I always do have a 3-bucket approach to managing their money over time, because I want them to, obviously I'm going to be prudent with money, but I want them to feel comfortable with what we have now, what we have in the middle, when we have long term, because I am looking out long term for them as well. And it's so easy to get just stuck in the here and now over the next 5 years or even the next year, based on what the news is showing or the media or whatnot too as well. So what I'm getting at is you have to stay invested at all times still, even once you retire. Yes, you may be more conservative. Yes, we may keep more cash on hand inside your account to cover your lifestyle essentially, but there are 3 buckets going on, and we actually have a significant amount of your money still invested long term, like 15 years plus inside of there, that we need to grow as well to cover expenses over time. So that's a real, hopefully simple example of a distribution strategy for retirees, like what a financial planner advisor will do inside of your account for you if they take the proper steps and really plan for you. 1, 2, 3 decades out for you, your money, your inheritance, your estate, how to transfer that wealth to the next generation, and so on. So it's funny to think, we're very focused on the short term too, obviously, and what's going on in the world, but I plan so far out for my people too, and I always want them to know that too. And really, if whether you're self managing or you're working with a financial advisor, you should plan. Again, you're 65 maybe, and you're retiring. You're young, but you're still young. Actually, you may not think or feel it anymore, but your money needs to be invested like you're still young, because it needs to last. It needs to grow for you. You need to beat inflation and the living cost above and beyond, of course. And then create a little nest egg for yourself, for your spouse, for your family, that if you so desire. Thanks so much. Hopefully that helps a little bit on the distribution strategy for retirees and just the 3-bucket approach.